Hopefully the government doesn't shut us down again. Look at that.
Hey, we're in.
Adam's internet's back up.
Happy holidays.
Thanks for
Right when I said
no comment.
For a minute.
no, yeah, we'll abstain from commenting. Well, it's a hot Wednesday. It's been a weird week of weather here in the Chicago greater.
Sunday hot, Monday hot.
Are golfers still doing this? You guys are the golfers. Are you guys
Yeah.
still planning?
We're
hitting the links.
This
Yeah.
is where
see
you,
the burn.
this is where you get the subtract one stroke for every beer drink.
Yeah.
This is where you put a 48 up on the
So
card.
do you still have to wear like the collared shirt and whatnot? Can you just like do like a tank top? I'm a big cutoff sleeves.
I mean, it depends on where you're going.
Okay,
But yeah,
We could get you on a course that
you
will allow
can
the
go shirts
cutoffs.
off. There's a couple courses in Chicago that let you do whatever you want. Bobolink,
really?
you can play naked if you want. I'm telling
This week?
you. Yeah.
It might say,
See if they have
Sabrina,
a
you wanna
tea
go play
time
her-
for this afternoon.
I've never been there. I just heard about it.
All right.
rumor has it.
There are no rules.
I'm gonna head back, freshen up some grooming. We can be there by 2.
Women are not allowed in that course either. So
Awesome.
Oh,
That sounds like a beautiful place. No women, everybody's naked.
okay, here we go. All right, what do we got today?
Is this
Pride Month.
is this Bobbly or is this is this Roselawn or wherever the sun, whatever the Ponderosa Sun Club?
Ponderosa Sun Club over the border.
Great
Yeah.
place. Great place.
Great, one of your favorites, huh? Great
New
place to buy some real
Nudes
estate.
are popping, man. In the 90s, boy, that was the thing.
Literally popping, huh? All right. And now we've gone completely off the rails, which is great because I think we labeled this episode Naughty by Nature. Are you down with OPP?
Yeah, you know me.
You probably don't. We probably shouldn't explain what OPP is on this, but we'll call it DPP. How about that? So down payment plus.
Down payment plus.
Other ideas.
Yeah, you know
crazy.
me.
Yeah, you know me.
Displaced persons.
Yeah, there we go. Plenty of those. Hey, you got. Hey, as long as you got Social Security. Look at this. We're getting real wild. I love it.
They're dirty. All right, what do we got? DPP. What's that all about?
Well, we got just down payment in general. So I think a few weeks ago we were talking with Tony about how to make your offer if you're a buyer as strong as possible in a market where there are practically no homes for sale, right?
Yep.
And
And you have competition.
tons of competition, and I think that there's this misconception or misunderstanding. We've talked about this a lot of different times on like what a seller paid closing cost credit is.
Okay.
And like you just don't go. It doesn't just come out of the air; it comes out of the seller's pocket at closing day, right?
Comes out of profit. Yeah, is that a good way to say it?
Yeah.
Comes out of their bottom line.
It comes from the seller.
Yes.
Yeah. Like,
It's you're hitting the seller.
Yeah.
It's another thing that you're hitting the seller for.
and then you get to a point here, and I know Tony, you're very, very refined on how you coach up your buyers to write offers, making sure they're not writing for overvaluation or anything like that. So like this idea of just, we need 4% closing cost credit to reduce my bottom line. We'll just add 4% onto the purchase price.
Well, and part of where it comes from and why I wanted to talk about it is because I'm sorry, but your world occasionally does a bad job with the mortgage world.
Our world sucks.
Well, what I mean by this is by preparing the buyer for what they're about to do. All right. We received the buyer is fully pre-approved. And he's all excited. He's got this pre-approval letter like, hey, I'm just as strong as anybody else. Right.
Mm-hmm.
Like now I got this. All right. And the mortgage guy didn't tell him, they may have covered, hey, you're going to have to get some closing cost credits, but they don't ever cover like how hard that is to do. All right. On my listings, which I list more than I help buyers. All right. So one of the things that adds contract strength, which is as important as final sales price, is this guy's financing and the strength of the buyer. And I have to say, when we have like 30 offers on a property, we have 10, we have 5. All right. The first thing we're doing is throwing away offers that have seller credits. All right. And here's the reason, the theory behind that. We know you're not as financially strong if you need a credit for us. Okay. Yeah. But the bank financing is good. Well, how I read that is you're going to have an inspection. When you have an inspection, things that are going to cost, $1,000, $1,500 are going to freak you out because you don't have the money.
True.
So we know that once we're under contract, you're much more likely to hit my seller up for credits, things to be repaired, because you move in, we know you're not going to have the money to do it. And I'm sorry, that's just the way that it shakes out.
So you guys get like these offers in. I'm picturing you like having a depth chart. Like, hey, we looked at this. This guy looks good, and then you're like, which one's going to cause us the least amount of problems?
Absolutely.
Bingo.
Absolutely. So we present it. They have everything. Usually it's in one day. You get a presentation. You got a link to all their stuff, and then we do a summary on each
potential buyer
offer.
Okay.
Okay. And they can reference back to it. And that's what you add to your summary, and the things that you're looking at are what make a really good difference between agents. That's where agent quality and paying to have a good one comes
Yeah, like
in.
your bullet points need to be on point there. Like,
Yeah, we're looking at how the offer was conveyed. How did it come to us? How was it presented? What is the production of the agent that presented it?
right.
Is it complete? Did they either try to sneak something in accidentally or make an error that shows that they don't know what they're doing? All right, you got to weigh everything because it comes down to these things. This is not to say that we won't, if you've got a great agent and it's a lender that we know, all right, and the guy needs a seller closing cost credit and net sales price is about the same versus an agent that presented it sloppily, missed some things, tried to throw something in, we'll go with the closing cost credits if everything else lines up. Okay. But normally it affects you. So what I wanted to talk about down payment is occasionally we'll see buyers who can get the down payment that they don't have from somewhere else. All right. And they didn't even think of it. And now you're in the midst of a negotiation. You got to get it from the seller when it's like, hey, we could have done this. And I didn't even have to ask for that.
And I think where it starts.
You lost me there. I don't know.
Well,
so the guy had access to a way to get a down payment, didn't think of it, didn't know of it. And now I've got to negotiate for you to get this credit, which makes you lose the deal.
When you didn't even need it.
Where it's like, we didn't even need to do that.
You lost the deal because of something that was avoidable mistake.
Avoidable. Got it.
Right. A 3-putt, if you will.
I always
ask. A Rory McIlroy.
Rory.
Well,
we got to talk about that. And we'll leave it in.
We got all kinds of good stuff with that.
Well, I always ask you, don't I? Like, is there any way we can avoid this?
Yep.
All right. So we talk about other things like.
Well, so we actually have a customer right now, right? We talked about utilizing what we call in our world premium pricing. So a little bit higher of an interest rate. It allows us to do a lender credit instead of doing a seller credit, right? And in our case of the buyer, her payment went up $18 a month, but she's $4,000 ahead. And on a house that probably had 15, 20 offers, now her offer stands out, right?
Absolutely.
That one works. A couple other ones that we've talked about, we've had mutual customers. All three of us have a mutual customer. They wanted to save up money. They sold blood plasma.
We did have that. Let's go back to the buyer premium thing.
Yes.
Okay? It seems like, when people go to get pre-approved that you hear us talk about often, the consumer is super rate conscious because they know they're going to get hit with an interest rate and they know that their job is to try to get the lowest interest rate possible. When you have like nothing of your own money into it, you're not like the world's greatest buyer. Okay. So there should be other things that you consider other than the interest rate. Like, can you do some things like, hey, maybe not the best interest rate. Can you change the interest rate a little bit to improve my down payment situation? So if the payment only goes up a little bit and you can either preserve some cash or qualify without asking for those closing cost credits, this is going to be what makes the difference between you getting the house or not. So let's not be so interest rate conscious. We have to be conscious about what the payment is, obviously. What is the payment and what do I look like and present as a buyer?
The two biggest misconceptions about your financing are your interest rate and PMI. PMI is like the swear word in church, right?
Oh.
It's boomers freak out. Oh my God, you didn't put 20% down?
PMI.
65% of the world, and we'll talk about the difference. Last week we talked about title insurance and how that's different than homeowners insurance.
93% of all statistics are made up.
I literally made that one up. Busted. Anyways, there are a lot of them. PMI, private mortgage insurance, is what insures the lender for the difference or losses that they would take in a foreclosure situation if you don't have 20% equity on a conventional, or 20% down on a conventional loan.
Yeah.
It's not your homeowner's insurance, which is the insurance that takes care of your house in case of a catastrophic loss, tornado, lightning, all of that stuff.
Often called hazard insurance, which throws people
Yes.
off. Hazard. I have hazard?
Yeah. A lot of hazards. Yeah. Stay out of them. But PMI, right? If you have a strong credit score, it's very, very affordable. And if you look at it from a blended rate perspective, okay, so now instead of putting 20% down and worrying about that, and then having the closing cost, well, I can maybe put 15% down, preserve some cash so that I have a little bit of money set aside to do those necessary repairs or updates to this house. And it's only going to cost me an extra 15, 20, 30. I mean, ask your mortgage person how much more a month. That's the strategy. That's an idea there.
You guys put the rate in a blender?
We do.
Mm-hmm. A ninja.
Particularly a ninja. We put it on 1, 2, 3, and then we pulse it.
I think with PMI, as long as we're going to touch on that, people think about PMI as either it's this big thing and I either have it or I don't. And if I have it, I'm a bad guy. It's going to cost me. But it doesn't work like that, right? There's a matrix. It's based on your credit score and down payment.
Yep.
Okay. So there's different levels based on credit score, and there's different levels based on the loan to value, and it's broken in 5% increments, right?
Yep.
Starting at 80 LTV,
It goes
80 to 85,
Yep.
85 to 90,
Yep.
90 to
95.
And then stuff
And
gets
then-
kind of crazy.
Yeah. And then you have 95 to 97 now.
And I want to talk about that too, going into down payments. All right, back to down payments. That's going to come into play in a minute here. But if we're 80 to 85, it's like next to nothing. If you have a 790 credit score and you want to put down between 15 and 20%, your PMI is
Literally take your loan amount then, multiply it by 0.0018 and divide that number by 12. That's your PMI.
So like $11.
Yeah, man, it's what he said.
I mean, we should probably get some visual aids at one of these points, but
A little bit.
yeah.
So all of these things designed to like make the buying the house affordable. And the number one thing you can do to make your situation affordable is down payment, right?
Yes.
So trying to avoid you actually having to ask the seller for some assistance. And we can do this if we have to. We want to try to avoid it in today's market environment though. All right. So we have you increase the down payment yourself, your own funds. You either can or you can't. Now, if you can't, there is acceptable places that you can get those monies from to pay for the closing costs. You can increase the rate. Say that you can't increase the rate or you're maxed out on that and there's still some costs and you need some down payment to cover. Gifts. Let's talk for a minute about gifts. I think when we say the name gift, people think of this as like this is this big deal and whatever. Tell us about the gift and who can a gift come from and how does it need to be documented? So
this is awesome because FHA just published some guidance recently. They've updated their requirements for a gift. But it's going to depend on loan program, right? So if we're talking about FHA, VA, or USDA loan, all right?
Government products.
Yes. Specific government products. Gift has to come from a family member, and that family member tree cuts off at cousin. So a cousin cannot be it. But brother, sister, aunt, uncle, grandma, grandpa, grandma, in-law, grandpa, in-laws on that side, right?
Sons.
Yes, sons.
Daughters.
Exactly.
In-laws?
In-laws, yep.
Wow.
Also, a very specific one, a person with a documented interest in your financial well-being.
Ooh.
So in that case, a domestic partner.
Cool.
A significant other that you have children with that you're not married to.
What about an employer?
You can get employer gifts. I actually did one. I won't name the employer, but a very large corporation gave a customer a month ago, $9,000 in down payment assistance.
That's pretty cool.
Because the cost of retaining employees, we've talked about this
deal.
before. It's a big deal. It's super expensive to constantly churn through them. Well, why do people always they silently quit, right? It's because stable housing is a very, very important thing for someone with 2 or 3 kids, right? You guys all know this.
Mm-hmm.
So the borrower research goes, oh, my company has a fund to help people buy houses.
Wow.
$9,000. It was a taxable event for her, but got that right. But so gifts in particular, right? So we talk about
So
family,
the familial gifts and these relation gifts from somebody who's related to you on taxes too, right? They're generally not taxable.
That is correct. So the IRS, that's one thing that we get hit on. Well, I got to pay the donor's got to pay taxes on this. Nearly impossible. You can do your own research. I'm not going to sit here and preach tax advice for you. If your donor gives a gift, there is a annual limit. However, you just have to report that gift. At the end of the day, if that person, that donor didn't gift, I want to say the number is now like $11.4 million in a lifetime.
It's 11 million.
There's no tax. So unless Daddy Warbucks got a fat knot, and then you're probably not calling us for mortgages and all that stuff. You're paying cash.
11 million.
11 million tax free gift
without paying tax.
I think that's coming down, by the way.
Yeah,
I would. Yes, at some point, we're probably because of us. Mm-hmm. But that's a concern. Now the documentation part, right? So we go through the family tree. Who's eligible to give a gift, right? All of those people except your cousins can't. All right, we go through that. Gift letter, right? We literally send it's a can letter. Bam, we're giving Tony.
What's the essence? Yeah, what's the essence of what it needs to say, and what are the key components of a gift letter?
So let's just
you guys provide a sample, anyways.
Oh, you just give us the information, we plug it in, we send it out. So
you sign it.
You're my uncle, all right, Uncle Tony. So I, Tony Mitadero, give $5,000 gift to my nephew Tony Perry to buy house. Insert address. This gift is a gift. There's no expectation of repayment. Here's the amount. Here's my address. Here's my phone number. We don't ask you for your social security number. We don't ask you for anything else.
No, they have to agree to say that there's no expectation of repayment, but that doesn't mean that if you want to repay the guy in the future, you can.
Oh, hey, you guys do whatever you want. There just is no expectation.
Exactly. That's an important part. All right. That's a real important part. I know people of significant financial status who've used gifts from people, depending upon what their financial situation was at the time that they were entering into a contract. Maybe you've got your money tied up in a whatever. Shit, when I bought my house in Rosewood, I had all my money tied up in a rehab, and I needed to borrow like 50 grand or get a gift of like 50. So it just so happened like I couldn't wait for the one to sell and whatever. And I had like 2 or 3 of them under contract, and like I just wasn't going to have the money actually. So I took a gift and I paid the money back in 3 weeks to the guy, and he did agree to, like, if it's just a gift, but I paid the guy back and nobody cares. It was whatever.
Yeah, you gifted it back, right?
The concept is that the underwriters want to make sure that you're not taking on a new debt obligation that has a payment that could throw your inability to repay their loan off.
Your debt to income can't be affected.
So let's talk about how on the government side things have changed a little bit. All right. So you gave me the $5,000 gift. Now Uncle Adam is going to give me another $10,000 gift in this situation.
Okay.
Prior to the end of May, I would have to go back as the mortgage guy. I'd have to ask Uncle Adam for 30 days of bank statements to show that he had the money to give the gift, and it didn't come from a round robin from the seller was the main concern.
Yeah,
it's not 2012 anymore. HUD finally brought some real clarity to that. So now I don't have to dig into Uncle Adam's bank statement anymore. I just have to get a snapshot to show that within 2 or 3 days,
there was
Uncle Adam had the money. He wired it directly to the title company.
Wow.
And he signs the gift letter. He gets a statement to show the wire out to the title company, or the cashier's check out to the title company. Case closed.
Fantastic.
Wow. Seems a lot easier, huh?
Way easier than trying to go, hey, Uncle Adam, you want to give me that bank statement? Oh, look, you had $100 in there, and then you transferred 10,000 from some other account. Now I got to get this other account. Hey, what's this huge deposit here? Yeah. There's a large concern about money laundering because real estate's the number one tool for money laundering. So we're obligated to make sure that we're not stacking and doing all those other things in AML law. But
so that's quite a bit easier. Is that applicable now to Fannie and Freddie stuff?
Fannie and Freddie have always allowed that. Well, I guess not all. In the last 5 years, they've not. You haven't had to go back into a donor statement.
Okay.
So Fannie and Freddie also have a little bit more expanded definition on who can give a gift. So cousins allowable. They're a little more flexible about that. FHA is a weird one though about fiance. So we have to show documented person with documented interest and financial success type thing.
Okay.
Um,
So basically, there's a wide range of people that you can get
Oh,
gifts from.
and this is the crazy part. Like, people are afraid to ask parents. You'd be surprised at how many parents are like, oh, I'd help them out.
Yeah.
Like, I know how much it costs to go to the grocery store now. I'll take care of it. I talk to people. Oh, hey, we're gonna get after that conversation, Tony. We're gonna give these guys $20,000.
Right.
And they were afraid to ask for them. Like, just put me on the phone with mom and dad. I'll talk them through it. We can explain why. So yeah, gifts are a good one. Now I will tell you this. Wu-Tang used to always say, "Cash rules everything around me." You don't want cash. You need to have an honest conversation with your mortgage person because a gift does change the underwriting risk of your mortgage. So flipping, we have to click like 4 buttons in our system to run the file through automated underwriting on the gift. A gift is a weighted or a layered risk.
Mm-hmm.
So don't just drop that surprise on your mortgage
Because
person.
it will change the cost of your loan.
I spent 6 hours yesterday
It
pulling my
changes
damn
the
hair out.
underwrite.
Yeah.
Yeah, not the cost, the underwrite. So the risk that being able to do the loan. 6 hours yesterday on 3 different situations where borrowers said that they had their own money. We get the bank statement. They spent their own money. Now we introduce a gift, and the file has to be underwritten differently.
Got it.
It's not a fun thing, but just have a game plan, right? My favorite one, oh, I got all the cash in the bank or in my safe. No, you don't.
Yeah. Well,
you don't have it there.
so a number of ways, right, to get it. Number of people. Documenting it's actually pretty easy. So think about who these people are and ask them, or allow your mortgage originator to step in and explain to the family member, what this is and how it is, and then try to sort that out before you're looking for houses so that you can put yourself in a position where you look stronger on paper, because the piece of paper having the pre-approval, right, is going to present differently depending upon what we have to do for you specifically, right? So if we don't have to ask for seller credits, that's going to make you look better and dramatically increase the chance of you getting it. Now, outside of family, right, there's some other things. There are some down payment assistance programs that are usually internal to the bank, some form of government, or some form of private entity.
Yeah. So these ones are where it gets messy, tricky, right? We'll talk about all of a sudden you're using other people's money, other people's assets. You fall into a box of restrictions. So U.S. Bank deals with every state housing agency in the United States. So all 50 states have their own state housing agency. Each one has their own down payment assistance programs. Illinois has theirs. Indiana has theirs. They are drastically different, which is crazy because they all go to the same place. But I think each agency weighs it out and goes, this is what our community or this is what our state needs. Where these run into problems, they have a set amount of funding per year. Once you get that set amount of funding,
money's gone.
It's gone. And it's like that South Park episode, and it's gone.
Yeah.
But relying on it early in the year, not a bad idea. Later in the year, you may lose out on a great program. Like 2 years ago, Illinois' version came out with this HFA1 program. It was smoking hot. Came out in February. It was out of money by September.
So hot.
So hot.
I used
So hot
it.
this
I mean,
season.
those first-time homebuyer things are amazing. Like my first condo I bought, I think it was like $7,500, and I had to keep it for 4 years. All those
Okay,
programs
you were
are
in that
amazing.
thing. How much money are we talking?
So the IDA program, so Illinois side, the maximum is about $10,000. It's going to be, it's an equation based on which program we're going to take, and then the percentage of purchase price. But 10,000 is about the max.
Okay.
Indiana, I want to say is 3.5 to 4% of the purchase price.
Wow.
So there's still a cap on there too. But you can, like, if that covers your down payment, now you're just worrying about closing costs.
That's amazing.
Okay. And these are all generally first-time home buyers. So this sounds great.
Well,
Adam's over here going, this is awesome.
You actually, here's what's crazy. These are not first-time home buyer products.
Really?
Yes, you can do, like,
How does one qualify?
they've lifted most of the restrictions on that. So one of the trickiest parts about this is, let's just say, it's the 21st century and it's June. So you and I are married.
Yeah.
Only you are on the loan.
Yeah.
The mortgage company has to verify my income on that to see if we are below the area median income threshold. So there's like a couple extra steps about that for qualifying. And then the other process, it has to be your owner occupied property. So if you own a house now, you do have to sell. You can sell the day of and move out. So for whatever reason you're strapped on equity, you can
Pretty cool.
tap
Were you
that.
about to devil's advocate, the first time home buyer?
Yeah.
Let's hear that.
All right. So like, yeah. Well, no, it's like.
Come on, Uncle Tony.
All right. So this one sounds great. I will tell you this: the gift from a family member is far better than this, and here's why. From the listing agent's perspective, when you're presenting your offer with this in there. Now, in Illinois, there's no section in the contract to disclose whether or not the buyer is using a DPA, down payment assistance program. All right. In Indiana, there is a checkbox in the mortgage contingency area that tells us whether they're not using a DPA or not. You're not required to check it. Most agents do. If you're a good listing agent, like some of us may be, when you see a high LTV, low down payment buyer's offers, one of the things that you're asking the buyer's agent and the originator, because they may not tell you, is are you using a down payment assistance program? All right. We're using this to vet strength. One of the problems that comes in is not all mortgage companies are created the same. One area that a lot of mortgage companies really goof up is with IDA in particular, right? Because they don't understand what the dance internally is going to be like between themselves and who's underwriting the IDA product, all right? Because in the back end, that mortgage company is communicating to another third party that's issuing the funds or approving them. So it's like they're underwriting in-house, and then it's going to these guys, and they're underwriting it as well, and then it's coming back. They may have some changes, ask for some things. You added an extra layer of complexity, and those deals have a tendency to run long or fail if the end lender doesn't have a lot of experience. Now, I know in Northwest Indiana and in Illinois, at my stage, we pretty much know who the originators are and lenders are who have a lot of experience with it. You guys, some of the big names you know are real good with it. You don't even know that this process is happening. But some of these, and I shouldn't even say smaller because some of the bigger ones goof it up too. But the originator, if his processing staff doesn't have volume experience at this deal gets bogged down.
If his processing staff doesn't have a process, if he doesn't have a process,
yeah,
right, like it starts on an initial conversation.
So greatest strength, number one strength, which I want to talk to you about in a second, is you just put the money down yourself. All right. Greatest strength, if you don't have it though, is a gift. Nobody knows on the other side. Nobody knows, and nobody's finding out because the mortgage originators don't ever tell us.
Oh.
All right. So that's
it's like that Emmylou Harris song, Long Black Veil. Nobody knows but me.
Down payment assistance from somebody else. DPA from somebody else, though, can be real good. Occasionally there's some grant programs that you really don't have to do anything, and they're just going to give you the money.
Yeah.
That's awesome. You guys have had some internal programs.
So
right?
we do. So we have the DPP, also known as the OPP.
Mm-hmm.
So down payment
Find
plus.
Dallas Page?
Yeah, exactly. Yeah, there we go. So Novus is a division of Exonia Bank. We're on the advisory board for the Federal Home Loan Bank, which is like an institution similar to Fannie Mae and Freddie Mac. Their sole goal is to promote affordable home ownership. So we have our own program. Again, it comes with some restrictions about area median income, but our program is based on either purchase price or a flat dollar amount, whichever one you want to do. You get to do pre-purchase education, so like an online course, and then you get to do a second one, pre-purchase education. The course is like $149, but you can get up to $5,000, almost $7,500.
There's money everywhere.
The best part about this program compared to IDA and Indiana's like IHTA or IHCDA, our second lien. So when you get that's the tricky part, the devil's advocate part from the mortgage side. You do IDA, you do Indiana one, you do one of these federal programs. There's a second lien for that down payment fund because we want to promote home ownership. We don't want people to abuse that product. That second lien will not subordinate. So you're stuck with that mortgage, that first rate, whatever that rate is.
And this is with what program? With the IDA?
IDA and the Indiana bond program.
This is important because you heard in the last year or so, year and a half, these agents talking about date the rate and making it sound like you could just refinance if rates drop. Well, rates didn't drop, so it doesn't really matter anyways. However, if they had, what he means by subordinate is you're not going to be able to refinance your mortgage while you still have this thing hanging onto the house. All right. When we go to try to finance something, you go to all lien holders and like, hey, will you take a backseat position to this first mortgage that the guy can
Hey, you
use
might
it?
step in
That's a
behind.
no.
Get behind, boy.
That's going to be a no.
Right.
We're not
So-
letting you play through.
Yeah.
So so IDA says no. So you have to know that you're either going to have to pay that thing off, or you're in it for how long does it take?
Depends
to fall off?
on the loan, which IDA program we do. We have ones that fall off in 4 years, 5 years, and 10 years.
Okay.
Yeah.
It's a great question to ask your mortgage person. If they tell you IDA or the Indiana one or the state housing agency, oh yeah, you can refund, they're lying to you.
Right. Yeah, because there's no subordination in it. So we can get a gift, all right, or we can get a DPA, down payment assistance, and that can be the bigger dollar amounts seem to come from government agency in some form. There's some strings attached to it though. Grants are fantastic. They're generally few and far between. And then a lot of banks will have their own internal one because they're trying to meet a higher CRA score.
Yep.
Right. Community Reinvestment Act. These banks are scored on how much community lending, affordable lending. Now you've got to be in some type of income bracket to make that. Now we'll talk real quick about saving up for it, but more importantly, one of the reasons we talk about this, we talked about making you look good enough to get your offer accepted. And if we have to ask for stuff for a seller, it's going to dramatically decrease your ability to look real strong in a competitive environment. The second thing, and I really do take this into consideration just out of my obligation to try to look out for my clients, is I want you to have some equity in your house. When we're buying a house, people are always planning, I'm going to be here for forever. All right. I personally think you ought to have at least 5% in as a bare minimum. I know you can get approved with less, and if you want to do it, that's great. But what you need to think about is what happens if in a year, 8 months, 9 months, something happens and you need to sell that house. There's a cost to transaction. Realtors' fees eat up most of it, but there's other costs. All right. And I see people, this is why we went into the recession. People did not have the equity in their house to be able to sell it and get out of it before they could quit paying, before they couldn't make any mortgage payments. All right. So they end up losing them due to foreclosure, wax out your credit. It's going to goof up the next 5 to 7 years of your life. All right. So I tell people we need to do whatever possible to make sure we get 5%. And the nice thing about 5%, you can talk to them about lower down payment programs. They've got it. If you want to take this risk, it's on you.
If you want it, we got it.
But when we go beyond 5% or less than 5% down, that MI in some form, in the rate, through a private company, through the government, that PMI goes through the roof. It seems to be, it's, 80 to 85 is here, then a little bit for 85 to 90, 90 to 95 is a little bit more. And then beyond 95, it's like,
it
your costs
parabolic.
go up. Yeah. So your costs dramatically increase. All right. It's going to make it even harder for you to get the down payment down. All right. So 2 things. We want you to look good as a buyer, and so that we can actually get your offer accepted. But the second is I want you protected so that if you've got to come to me in 9 months, Tony, this happened, I got to sell my house. There's going to be enough equity in there where there's some likelihood of me being able to do something with it.
Well, yeah,
Makes sense.
Well, we talk about, we saying not all mortgage companies are built equal. Part of that is in Illinois, you want to sell your house, right? So you're going to have realtor fees, you're going to have a tax proration, and then you're going to have a owner's policy that, on the Illinois side, seller typically pays that. That owner's policy is going to run you $2,200-$2,300, throw an attorney fee there. Now you're at another $500-$600 there. So you're at $3,000 in title costs to sell your house. That's before the real estate agent. That's before the prorated taxes.
Right.
In Indiana, well, we'll talk buyer side in Illinois. You have $3,800 in buyer title fees in the Chicago metro area. That's on top of your down payment, on top of any other lender closing costs and all of that stuff. And that's where the other out-of-town online lenders and these call centers, they don't have that tough conversation with you up front because they just go, oh, well, we'll type this in the machine. Oh, a title's $1,000. It's like, no, it's not.
No.
I have thousands of transactions of experience. It doesn't cost that.
Yeah.
The Indiana side, I think owner's policy probably runs about $800-$900.
Right.
On buyer side, lender title insurance is about $800, $900 as well. So transactional costs are a little bit lower, but that all adds up. You go to sell the house.
Yeah. So those are the two things that are real important. Having these conversations. So the best way, one way to increase your down payment is to think about these things early on before we get on the scene, which comes into, having some type of financial plan, even if it's small. Sometimes we see these things, we see deals where people are like, literally, it's like $3,000 would have made like a huge difference if they had an extra $3,000, right? That's 10 weeks, it's saving $300, 10 it's saving an extra $300. Like, man, you can find $300 in your pocket change somehow.
I promise you can find it. We've looked, like I've talked about this. I stopped buying Dunkin' Donuts coffee 6 days a week. Right. That like just doing that changes.
And then the other part of that is, which we harp on it all the time, and I really do mean this, talk to a mortgage person early on. They're not talking you into buying. Most of them want to build you into a buyer at some stage. They don't mind telling you this is what you have to do, because I have people that build up in their mind on their own what has to be done. And then what happens is somewhere along the way, they're not reaching that goal that was based on nothing because they never talked to a mortgage guy. And then they just give up. And it's like, man, if you'd have talked to a guy who actually knows,
could have been a plan
a year ago,
you'd
be there.
The hypothetical fear, and I know you guys deal with insurance too, I'm sure all the time. Like everyone has these preconceived notions. And if you ask a professional, they're going to give you an answer. You call a call center, they're not going to give you an answer. We've had people, it just takes a little bit more time to think about it and plan about it. But at the end of the day, do you want to be, we're told we're going to weave this in. Do you want to be Rory McIlroy on 18 at the U.S. Open? I think he was 468 for 468 on 3-foot putts.
The last 2 holes.
You just completely fall apart. That's like when we're talking about presenting deals to your sellers, right? The percentage of hey, look, I'm up 2 with 2 holes left in the U.S. Open, going to cash a fat check, and then you just miss that 3-foot putt that most people in a regular round of golf are, hey, you're good.
Good. Did you see it? Did you see the putts?
Yeah. Oh, so close.
Heartbreaking.
And that's the difference between winning the U.S. Open or losing the U.S. Open. You're on a 10-year major, 10-year streak of not winning a major. Now you're not going to the Travelers. You're taking time off. You're not getting divorced. Yeah. It's those little things that you think that almost everything is there. But if you just don't line up that last little bit, you take it for granted. You work your ass off to get to that spot, to not do it, to not buy the house, to not have the right insurance.
Well, yeah, and just really the biggest thing though is like for me, like we can't have the attitude of like I've got this pre-approval, I'm as strong as anybody else. There is different strengths of it, and that there's an NAR cast a thing. I don't know what it's like. We're not supposed to discriminate against financial strength or whatever. Like anybody can clear as a bell see that there's a dramatic difference between this guy's cash, he controls his own money, and then this guy's FHA.
You're telling me that NAR put that in their ethics?
Yeah, you didn't know this? It was a big thing like last year. You can't discriminate relative to someone.
So hey, I got this. Well, it is wild. There's some stuff in our rules about us about a pre-qualification versus a pre-approval and what we can ask for. Listen, you want to shop with a pre-qual that isn't vetted, you didn't ask your mortgage person questions, you might as well just go to the used car lot.
Right.
Like you got a better chance of buying something there.
And then even if it is vetted though, like look, man, on my listings, I came from the mortgage world. I know that if you have 3% down, I'm sorry, if you have 3% down, I know that you're not as strong. The other one that gets me, and it used to get me on the south side of Chicago all the time, because they say, you don't know how it works around here. We're doing 5 times more business than your entire brokerage has ever done here. Okay, don't tell me I don't know how it works around here. Right? Like, well, it's an FHA loan. And I would ask the originator, well, why did they have to go FHA? What you mean, why they have to go FHA? All right. And this is what I would get, right? What do I mean? It's just as good as anything else. No, it's not. There is a reason why you went FHA. If your credit, income, and assets were strong, FHA provides the bank subsidized insurance that they would not receive from the private market, because the private market said that loan is too risky to include in the private market. So why did your buyer have to go FHA? right? These are the things that you face. What we're trying to do here is knock as many of these things that you could be up against with your offer off the table for you, present you as strong as possible so that in a competitive buyer's market where the seller head really has a lot of control, where we can make you stand out and get that property and hopefully get that property for less than somebody that maybe even was technically better than you, was just presented poorly.
Yeah.
You want to stand up like we're Lee Greenwood, right? Stand up, stand out,
Right.
Show up, show out. What else we got, Adam? We've talked a little bit about the U.S.
I
Open.
mean, U.S. Open was an awesome finish. Too bad for Rory. Awesome for Bryson, and probably Live Tour. I don't know how much money do you think he made on that last hole made Bryson. I mean, who knows what the Saudis were paying him to win a major?
Oh, that's right. Yeah, those guys.
I mean, he gets the 20-something million for the thing. He goes, oh, it's just amazing.
And like, you know, the guy has he was villainized for the longest time. Did you see the videos? Like the house he was renting, he was staying. He's in the streets at 10 p.m. signing autographs, hanging out with the people that hung out with him for a week,
drinking wine out of the cup. He was hitting like balls in the dark.
So like, you want to feel like that, man? Just call the right people to do the right things. Don't call the Saudis.
No.
Do not get a gift from the Saudis. That will cause a problem.
We don't like blood money.
Yeah, exactly. Blood diamonds, maybe, but not blood money.
Next week, when I want to talk about some personal articles policy.
All right.
People are. We had some misconceptions on how you insure like watches and rings.
How you insure a trophy?
Right, that trophy would be a personal articles policy.
Yeah, I'm interested in this one.
It's gonna be good. Tune in.
All right, cool. We got it. Make sure I bring some of my personal articles in. I have some firearms.
Yes,
that are probably not properly insured.
Let's bring them.
I have a crazy map of of Italy from like 1942 that survived.
Let's look at it.
Yeah, we'll get some valuations, but I think it's a big thing to talk about because guess what seems to be going up? Theft.
Yeah, golf clubs.
Man, I'm interested in this. The insurance. I've been talking about real estate for forever. I would be interested in hearing something.
All right, then you're gonna have to come in the studio with the vase that Tyler sold you. So that we can link it all together and make sure
I'm not bringing it, man. I'll take some pictures. That thing's heavy.
All right,
cool.
Nothing else. We're out. We'll talk personal articles, how to insure the finer details, right?
That's right.
All right, you guys
Money straight,
get out there
people.
and sweat.
All right.